Hello and welcome to Edison TV. I'm Charles Ashbourne, the head mining analyst at Edison Investment Research, and joining me today is Harry Anagnostaras-Adams from KEFI Gold and Copper. Many of you I know will know KEFI Gold and Copper, and this morning they had their third quarter operational results out. Harry, very good afternoon to you. Thank you very much indeed for joining us. So, third quarter operational results, operational update perhaps I should call it. And key feature that stood out to me was Tulu Kapi, and we're galloping towards project launch. Is that a fair assessment?
Fair enough, yeah. Essentially we're launching Tulocapi over the next few months, but also I think it's notable, and I think it's particularly important for a company working in emerging markets or frontier markets, that we've also got another project launching not too far behind that. So our Saudi gold project will be in construction probably about 6 months behind the Ethiopian one. So in a sense,
this is Jabal Karem.
Jabal Karem, yeah. Both frontier markets of Saudi Arabia and Ethiopia have their own stories to tell. They both have great potential geologically, in the same terrain geologically. Both have different politics, and both had hold-ups for us over the last years, but both actually pedal to the metal type of attitude today. So we're cracking on both of them.
So in terms of timelines, catalysts, milestones, what are the next few things that investors should be expecting to see?
Financing closings, the actual specifics of the agreements and the details of them. We've long spoken about what we're doing, and really, AIM, I'm sure you're aware, AIM is a particularly weak market at the moment, in terms of its ebbs and flows, and therefore it's reinforced the, I suppose, common sense of what we've always focused on, and that is to do our financing at the subsidiary level with regional players, regional banks, regional investors, and not to rely on the stock market as such. So that's important both in Ethiopia and in Saudi Arabia. So I think really from a shareholder point of view, even though shareholders are putting up a fraction of the capital involved, nevertheless they do own the company and they do need to understand, and we're looking forward to unveiling it as it comes together. And I think that's the important stuff for a shareholder. Long heard about the potential of these projects, but need to see the fine print to understand the detail. So in November, the banking's being recrafted and updated, because the last time we nutted out the terms was a couple of years ago now, and we had to suspend last year for reasons you may recall. Ethiopia was quite unstable last year, and having settled down, it's all back on again. And so the step one is to tie down, commit and announce the refreshed banking terms in detail. That then sets the platform for exactly the equity deals to slot in. There's board approvals around them, but they need to see the details of the banking before they can lock in. And then so November, we'll lay out those details on the banking, term sheets and final details, with a full wrap-up closing by the end of the year and launch by the end of the year. And then we'll have to give those warrants a couple of months to go through the mechanics of getting the market to understand, getting the market to appreciate, and getting the warrants properly priced and hopefully exercised.
So that takes us to the end of the year. Yeah. That's Tulu Kapi then financed, and then you've got a couple of years of construction, 23, 24, and then end of 24, beginning of 25, we're looking at production.
We're actually doing certain things that are in that development schedule already, trying to sort of take the edge off it a little bit already. But yes, you're right. It's a 2-year job, and we're already knocking over some things at the moment.
And then Capex, you announced relatively recently, has gone up a little bit from 300 to 320 million.
Yeah.
Not as much as a lot of other projects seem to be going up by. There seems to be quite a lot of capital inflation out there in the market generally. But I was going to say, how did you keep the rise that small?
Well, no, there was a big rise, but it crept up over a couple of years, and we we foreshadowed it a year ago. So, you know, if you go back a couple of years, you'd see numbers more like 240 million. And then last year we refreshed it, getting ready to close during the troubles in Ethiopia when we suspended the closing. We did refresh it, and the market was brought up to date. And so the change since last year was relatively small. So over the last couple of years it did go up a lot, but over the last year quite a lot less.
Yeah. And tell us what Tulocapi looks like when it's in production in a couple of years, because you're sort of, there was the open pit and then there was the underground, and the two are sort of slightly coming together.
Well, if you stand back from finance talk and just talk like an operator for a moment, what's the sensible thing to do? The sensible thing to do is to run what's the open pit and it's underground, which is the same ore body just underneath, concurrently. And the reason for that is that you're giving yourself multiple ore sources, you're spreading your overheads over a larger production base, and you're actually blending high-grade ore with lower-grade ore. Now, Tulocapi is a high-grade open pit and it's a high-grade underground, so the two combined are a high-grade combination. So operationally, very sensible thing to do, give yourself a longer mine life, as compared with just depleting the open pit and then standing there and saying, okay, now we'll turn on the underground, but we won't use the whole mill. You know, yeah. It's operationally sensible. So what we're doing now is the way we've structured the financing is to be able to bring both of them on. Now, obviously, everybody, ourselves, financiers, partners, everyone, will want to see the open pit start up, have a good look around, make sure everything is under control, and say, right, go on the underground. That's what we'll do. But in year 3, we'd start to see some ore coming out of the underground as well, year 3 production. And that means that we'll then have a blended operation, a combined operation, much more powerful, creeping up towards 200,000 ounces a year, and much more powerful with multiple ore sourcing.
Fabulous news. And KEFI's market cap at the moment is?
$25 million.
$25 million, so you can buy for $25 million something that could be producing 200,000 ounces of gold in 4 years' time.
3 years.
3 years' time. There we are. In production in 3 years anyway, definitely. And tell us, we haven't really talked about it very much, but Jabal Karem then is sort of on the conveyor belt, if I can put it that way, on the block as being the next development. Just talk to us about that.
In some respects, you know, it's a shame that it's overshadowed by being so advanced on Tulocapi. Everybody's focused on Tulocapi, and that's perfectly understandable. But in a sense, it's a shame that our Saudi story is a bit overshadowed. It doesn't deserve to be. The first comment I'd make is that as we sit here today, our Saudi assets on paper, do all the numbers, they're worth about the same as Tulocapi to us. So today, we're no longer a one-horse race, which we were a year or so ago. Now we're much better positioned as a company. Our shareholders can breathe easy that we've got a two-horse race.
Right.
And the second point is that Saudi is really on fire. I mean, in terms of the market for mining, the government support for mining, it really is on fire. It's quite remarkable. You know, most people in the financial community internationally wouldn't have been talking about Saudi Arabian mining sector 12 months ago. And today, I don't think I bump into anybody who's not talking about it. And that's because they are, when the monarch says go, they go. And we happen to have the first 2 mines to go into production under this new chapter.
Excellent. Now, you mentioned 2-horse race, which was Tulu Kapi and Jabal Karem. Actually, I mean, it's potentially a 3-horse. There's a 3rd horse, which is your second asset in Saudi Arabia, isn't it? Which is Hawiyah.
Yeah.
And you're doing a pre-feasibility this results this quarter?
Yeah, well, the 2 gold mines, Tulocapi, Ethiopia, and Jabal Karem, Saudi Arabia, 2 gold will be in production about the same time, the way they're both shaping up. Jabal Karem will be 6 months behind, I think, in terms of starting its construction, but it'll be 6 months shorter in its construction phase. It has no community to move. It has a number of jobs less to do in order to get into production. So we'll have, at the time Tulocapi starts up, Jabal Karem will start up. Now the third project, which is Hawiyah in Saudi Arabia, already is of a scale that exceeds the other two combined. More complex, multi-metal, copper, gold, zinc, silver, still growing, still being drilled in PFS, preliminary feasibility study, for the end of this year. So we can't be fixated on exactly the timetable because we need to complete all its preparations and planning. But the likely outlook for that is that once the other two have started, it'll go into construction. That's I think today's prognosis, based on both common sense timelines and what we'd aspire to achieve. And then we're heading for, in gold equivalent terms, we're heading for on existing resources, assuming no more growth in resources, which won't be the case, we're looking at a combined package of around 400,000 ounces a year.
By what year, roughly?
Well, it'll take, if the other two are in full production 25, Hawiyah will start kicking in around the end of 26.
Excellent. Well, we look forward to it, and we wish you the very best of luck indeed. Harry, thank you very much indeed. I'm afraid, ladies and gentlemen, that's all we got time for. My thanks to Harry Anagnostaras-Adams from KEFI Gold and Copper, who joined me today. We'll have more thoughts and ideas from the mining team at Edison in the very near future, but until then, you have a capital day.